If you're going to arrive early to a revolutionary technology that's and the first digital commodity that's monetized in the history of the world, you're going to be in for a bumpy ride.
Welcome to Dream Richer. Where do you think Bitcoin will be in the next 100 years? This question can bring up a lot of speculations and different theories. As Michael Saylor argues, today, however, Bitcoin will eventually reach crazy amount of numbers in the next 100 years. But that won't come without a bumpy ride first. According to Michael Saylor, the best strategy that he is personally using right now as well is dollar cost averaging. Dollar cost averaging is a good idea because it allows you to invest smaller amounts of money over a longer period of time, eliminating the fear of losing all your money. Also, it's easier to commit to investing a small set amount of money as opposed to large sums of money all at once. His investment method has been used for quite some time in the stock market with great success. When using the dollar cost averaging method, you are buying in at both the highs and the lows in the market. Hence, it averages out your investments over time, which is very much needed in a volatile asset such as Bitcoin. By the end of this video, Mr. Saylor unravels the mystery of Bitcoin's price and how he sees it going up from this bear market. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
So Bitcoin has been a continually bumpy ride for the past, many years. I think even since we got into the market, it's gone through nearly 3 cycles. And the only rational way to approach this is dollar cost averaging. So Microstrategy is in essence just dollar cost averaging into Bitcoin. Our strategy is we acquire Bitcoin, we hold Bitcoin, and we just happen to believe that 100 years from now, Bitcoin is like Manhattan, and you're just going to want to hold as many blocks of Bitcoin as you can. If you acquired Manhattan in 1907 and 1913, in 1917, in 1921, in 1928, 1932, and 1947, and then another thing in 1953 and 57. And you asked someone, what was the right time to buy? And do you regret having bought, the top? I can't even remember which of those years were going to be the most efficient times to buy. Generally, the view is that once you find a good thing, you just want to consistently acquire more as cash flows allow you. When I think about the way that the price changes, I think there's the demand side and there's the supply side. So if I was building a model, it would be a multi-dimensional, multivariate, nonlinear dynamic model. It wouldn't be a single variable linear model. It wouldn't even be a single variable dynamic model. So I think it's indisputable that the halvings have an impact. That is, when you cut the block rewards in half every 4 years, that has a positive impact on the price because that cuts the supply that's being sold in the open market by the miners or the supply that's out there. So I think that's one element. But my model for the price of Bitcoin is it's a function of adoption, and it's a function of technology utility, and it's a function of inflation, all 3 of those. And then it's presumably a function of time, especially in the sense that over time, the supply hardens, right? And Bitcoin mining supply decreases because of the halvings. So all of those are important variables.
The worst thing you can do during this volatile, bumpy ride of Bitcoin is to take on a crazy amount of leverage. Bitcoin, in theory at least, should be a safe haven from the turmoil of traditional financial markets. But in the last 2 weeks, as investors frantically sold high-risk assets, Bitcoin started to fall in tandem with the stock market. When a position uses higher leverage, it increases the chances of a liquidation occurring. For instance, if a trader uses $1,000 to trade $5,000, which is a 5 times leverage, then your probability of being liquidated is much lower compared to, let's say, a trader who uses $1,000 to trade $20,000, which is a 20 times leverage. For investors who are new to crypto, it's best to stay away from leverage and crypto loans until you develop a good understanding first.
In a world where you have 100 million Bitcoin users, using Bitcoin as their treasury asset, then you've got a certain demand. Now, if they decide they want to go all in and they want it to be 50 or 75 or 90% of their savings, adoption increases. When you go from 100 million to 500 million people using it, adoption increases. And adoption increases because of awareness. It's spreading over time. It increases because of crisis. For example, the Russian sanctions and the war in Ukraine, that drove adoption. Macroeconomic crisis. COVID drove adoption. Microstrategy never would have bought any Bitcoin if it were not for COVID and the lockdowns. So lockdowns drive adoption, pandemic drives adoption, war drives adoption, inflation drives adoption. A lot of the early Bitcoiners, they bought Bitcoin because of the hyperinflation in Argentina. So if you didn't live in Argentina, you didn't get struck by that. But all of those macroeconomic crises drive adoption. So there's good adoption. Technology is easy. Netflix is fun. I like watching it on my iPad. That's the good, easy, fun adoption. And then there's the painful adoption. Like in Zimbabwe, the currencies collapsed and they've announced they're going to dollarize. So what you have is all of the quasi-strong currencies weakening against the dollar. Some currencies collapsing against the dollar. And I got this other chart, which actually shows the change in asset prices against the dollar. And what you notice is that oil and wheat, right? The stuff you use to heat your home, move your car, and avoid starving to death. If you don't want to starve or freeze to death, those things are 35% more expensive. 40% more expensive in dollars. So if your food and energy are going up in dollars, and if dollars are getting more expensive in your local currencies, by the time you add that, you realize you've got serious, painful inflation. And that inflation, that drives adoption, that drives the price up. And of course, it creates the instigation. You could almost say the first order driver of price is inflation. You know, if the currency gets cut in half, the price doubles in Bitcoin. The second order driver of price is adoption, because people get afraid of inflation. And so they start looking for a store of value. And the third order driver of price is technology, because once everybody gets excited about Bitcoin and gets excited about protecting themselves against inflation, the demand for mobile phone companies or for Google or Apple or Cash App or PayPal to build better technology into their applications leaps.
It's clear from Michael Saylor's explanation that even though the asset has been highly volatile, but those who have held it long-term have reaped incredible gains. For example, if you invested in Bitcoin when it was first launched in 2009, your returns could be in the millions or billions because the initial value of the asset was $0. If you bought Bitcoin a little bit later and held the asset through the ups and downs, you'd still see remarkable returns from your initial investment. Though there are many stories of extreme gains from those invested in cryptocurrency, there are also many who have lost just as much money by buying and selling the choppy asset at the wrong time. So even though Bitcoin may be looking bearish right now, however, continue to dollar cost average as Bitcoin eventually makes its way up. Do you agree with Michael Saylor's explanation? Let us know in comments below. To learn more about the latest crypto news, watch these videos here.